another, and then how far do you go, right? Is it North Korea? Is it anytime either tax evader or somebody else is on it? Anytime, right? Like there's a government subpoena, do you have to comply with it? So there's kind of this slippery slope argument. That being said, right, they did convene to change the rules or, go different than kind of what the rules they committed to are. So I think, right, that's where Zach's argument is coming in, is that if you're looking at your own losses, there definitely is a potential kind of conflict of interest there, motivated reasoning from their side. So if you can arbitrarily change the rules for one thing, why can't you arbitrarily change the rules for the other thing? It's a tough question. There's good arguments on either side, to be honest.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin. We are now featuring quotes from listeners on the show. Today, we have a comment responding to my interview with the Ethereum Foundation research co-leads, Alex Stokes and Barnaby Mono. Unchained Yoda writes, "Don't think EF needs more research, maybe more shipping and fraud." If you'd like your comment featured, write a review of the podcast overall or leave a comment on our video on YouTube or X. This is the March 28th, 2025 episode of Unchained. Bitkey is the Bitcoin wallet from the team behind Square and Cash App. It's the first 2 of 3 multi-sig hardware wallet with recovery tools that replace the need for a seed phrase. Get 20% off with code UNCHAINED. Imagine an AI that speaks crypto and does the work of a team of analysts. Introducing Focal by Falcon X, bringing clarity to a world of noise. Visit askfocal.com. Mantle is building the future of on-chain finance. Experience its enhanced index fund, Mantle Banking, and Mantle X. Visit group.mantle.xyz to learn more. Today's guest is Doug Colkitt, founder and CEO of Ambient Finance. Welcome, Doug.
Hi, glad to be here.
This week, the crypto world was riveted by an unusual series of events on Hyperliquid. All of this happened on Wednesday, and it resulted in Hyperliquid's vault, called Hyperliquid Provider, which is its automated market maker, at one point being in the red by, I guess it was about 12 million or 15 million?
Yeah, about, I think, 15 million at the trial. So.
Okay. Yeah. So Doug and I were just talking before we started recording about how there's a lot of numbers floating around out there, and they're all a little bit different and contradictory, but we actually managed to sort through it all. So the price of Hype also dropped about 16%, according to CoinGecko. Why don't you tell us what it is that happened? And, as part of your description, just explain what Hyperliquid is for listeners who may be unaware.
Yeah. So Hyperliquid is a perp DEX, which means, right, DEX being a decentralized exchange, perps being perpetual futures. So unlike a regular spot DEX, you can trade leveraged positions, and these are derivatives on crypto coins like Bitcoin or Ethereum, or in this case, Jelly. You can trade derivatives on those, and then all that means is that, right, there's a long and a short. They don't actually hold the coins on the exchange. They just kind of enter into these contracts where someone's long, someone's short, and based on the price, one side will pay the other, depending if it goes up or down. So that is what Hyperliquid is, and I guess we can jump into specifically what happened here.
Yeah, so go ahead and tell us how this series of events got started.
Right. So like you mentioned, you have the HLP vaults, which are basically a way for ordinary. So traditionally, like in most exchanges, right, like liquidity is provided by market makers or professional trading firms, which is often the case on Hyperliquid too. There's a lot of trading firms and professional market makers there, but they also have these HLP vaults, which are basically a way for ordinary retail depositors to come in, commit capital to like these types of strategies that historically have been very good in terms of returns relative to risk. Market makers tend to make a lot of money. And so ordinary people can contribute to these strategies, contribute to the vault. The vault does two things. Number one, it provides liquidity in these markets, meaning it's ready to buy when other people want to sell, and it's ready to sell when other people want to buy. As well as in perp dexes, you have like what are called liquidations, which mean that when a user, they have a levered position and it goes against them too much and they don't have enough money to back up the position they have, the system closes them out, takes their money, and then their position gets closed out, but someone has to take over that position. And that would be called the liquidator vault, which is one of three components in the HLP vault. And in this case, the liquidator vault was attacked based on kind of the rules it had to operate by.
And when you say attacked, what is the, so it started with a whale who entered into a series of positions.
Yeah, exactly. So it was on this coin, Jelly, which was a kind of meme-like coin that was popular about a month ago, but since then has been down a lot. And basically the coin, I would say it's almost dead, but much less liquid, much less active than it had been about a month ago. So I think up until yesterday, really nobody was trading in this market. It's very thin, not a lot of activity. And so what appears happened is a whale came in and then was able to not only make large trades on Hyperliquid on the perp side, but make large trades on the underlying coin itself. So this market, right, is based on all perps markets have to look at the spot market, and they have something called an oracle that tells them the right price. And so what this hacker was able to do was go to the spot market for Jelly itself, which only had about, I think at the time, 2 million of liquidity in the liquidity pool. It's a Solana meme coin. They were able to drive the price up from about make sure I get this numbers right, about 1 cent. And they were able to drive the price up at one point all the way to as high as 5 cents. So obviously this costs money because you have to trade into the liquidity pool, pay fees, take those positions. But they were able to take two very large positions on the Hyperliquid exchange on the perps. So they took both a large long position and a large short position. And the idea was that, okay, so basically the market had very little open interest, but because they were essentially trading against themselves to build up this position slowly over time. So they were on one wallet were long, on another wallet short. And this is something, right, DEXs have to face is, right, like anyone, very easy to open a wallet compared to spinning up like a new entity on like Binance or something. So they were able to take a long and a short position. Then they were able to go into the spot market, move the price up, which meant that their short position was liquidated because they just didn't, right, like intentionally, they didn't put a lot of capital in there. And then the way the Hyperliquid liquidation system works is if the system can't liquidate in the regular order book, the vault steps in, takes over the position, takes all the capital in the position. So they lost whatever margin they had to put in to back that short position. But that created a situation where the Hyperliquid, the HLP vault, was short at very, very large size, much larger than the market had liquidity for. And now the whale had a really long perp position on. So Hyperliquid took over that position. It was about 1.5 cents, somewhere around there, when the short got liquidated. Now they're sitting on the long side of the perp, as well as driving up the price in the spot market. And as they were doing that, now HLP was short, which meant the higher the position went, HLP was, taking losses, at least on paper, and would eventually, right, has to work out of this position. And the only way they can get out of it is actually to sell back to the only other person in the market, or basically they were 95% of the rest of the market, which is the whale. And the whale would just say, well, I'm not going to sell to you. So the price kept going higher and higher. And right, theoretically, there's no upper bound on how high the price can go. And so there's no upper bound on how much losses the liquidity provider could take. So the HLP vault itself was in danger of getting liquidated if the price of the coin went to 15 cents. And then so at that point, a Hyperliquid, the protocol, stepped in and kind of did something outside the normal bounds of operation, which we can get into.
Yeah, well, let's talk about that because, this has generated a lot of just interesting commentary and controversy. So how did they resolve it?
Right. So what ultimately all perp DEXs have to have at one point, they don't have access to infinite money. They don't have a money printer. So if one side just keeps going up and up and there's not enough on the other side, and nobody wants to step in and take the position, eventually you have to, it's called like deleverage the market, which means you're going to have at one point force close positions just because there's no more money left in the market to support those positions. So The normal system is, if it depends on the rules and they're not super well documented, and Hyperliquid's closed source still, so nobody knows the exact rules. I don't think, as far as I know, or besides the internal developers. But at one point, if the vault itself got liquidated, they would have to force close the market. Everybody would be closed, like auto deleveraging is what it's called. Everyone would be closed at like whatever the last price was in the market. So if this whale continued to drive up the price to, let's say, 15 cents, the vault would have been looking at I think it was a $60 million loss if that happened. And right, theoretically, this vault, which is actually pretty important to the product, it's all kind of retail investors would have been wiped to, well, at least this component of the vault would have been wiped to zero. So would have been bad for kind of the ordinary users. So what they decided to do was intervene and manually delist the market, which means basically they closed the entire market. And so every position was closed. And really kind of the controversial part was they didn't close it at the current price at the time they closed it, which I don't know the exact time, but it was around somewhere between 2.5 to 5 cents. They might have, 5 cents was kind of the last price it traded at. Some people said it had gone down before, but regardless, they were looking at around a $10 million loss, $10 to $15 million loss if they had closed it then. So they had a loss on paper. If they closed it, they would have kind of realized the loss and been locked into it. The attacker would have walked away with 10 to 15 million. And so, right. So that's normally how like it would have gone if they had closed it in kind of a fair way based on the actual Oracle price. They manually intervened. The validators in the network fixed the price at around 1 cent, like 0.95 cents. And so the attacker actually took a loss on the position because they closed it at kind of an artificially low price, which they said was the price before the manipulation began. So that was pretty controversial in terms of them kind of picking an arbitrary price.
Okay, yeah. So before we get into the community reaction about that, we're going to take a pause to hear a quick word from the sponsors who make this show possible. BitKey is the only Bitcoin wallet on Time Magazine's Best Inventions list of 2024. Built by the team behind Square and Cash App, BitKey is a 2 of 3 multi-signature wallet and the first hardware wallet with an innovative recovery suite that eliminates the need for seed phrases in self-custody. Their new inheritance feature means BitKey's not just the easiest way to self-custody your Bitcoin, it's the easiest way to ensure it ends up in the hands of loved ones when it's time for it to leave yours. Learn more at bitkey.world. bitkey.world. Use code Unchained for 20% off. Picture this. The crypto market just got wrecked by billions in liquidations. You need to figure out what happened and what's next. But where do you even start? Meet Focal by FalconX, your AI-powered crypto analyst. It's like having a legion of experts at your fingertips, ready to break down market-moving events, chart DeFi protocol TVL, or explain why Solana mindshare is rising. Get clarity in a world of noise with Focal. Learn more at askfocal.com. We have another listener comment responding to Barnaby Mono's thoughts on Athena announcing its own blockchain. On X, Vidong Singh writes, "We don't need more blockchains." And then in all caps, he added, "We don't need more blockchains." For God's sake, let's focus on building utility and scaling the ones that are already there and promising. Again, if you want to hear your comment featured on the show, please write a review or leave a comment on an episode on YouTube or X. Back to my conversation with Doug. So actually, before we get into how people reacted to Hyperliquid's decision there was another twist, which involved Binance and OKX. They got involved. What happened with them?
Right. So as the price was right, you kind of think of like once the HLP vault was stuck in this position and everybody could see their liquidity, their liquidation price, because it's all on chain. So there's another thing, right? There's a challenge for DEX compared to a centralized exchange is everyone can see everybody else's position and where their liquidation prices are. And in some sense, right, you can be hunted, right? Like somebody can know, okay, if I push the price to here, this guy's going to be forced to liquidate or sell or whatever. And like, so other people, I think, started to pile on when, this position was at 5 cents. And I said, hey, we know like max pain is 15 cents. So we're all going to kind of pile on and attack it. So what Binance and OKX did was they announced that they were going to list the coin Jelly Jelly, which would be right very unusual for like kind of list this coin at the time they listed it, because it was basically kind of dead at that point. They decided to list it, and typically what happens when an exchange like Binance lists a coin is it goes up, right, because it kind of opens it up to a whole like realm of buyers. So it's a big deal, right? Exchange listings are a big deal. So the fact that they listed it itself created a pump in the coin, and the fact that they kind of listed it immediate, like while this attack was going on, was a pretty clear signal that they were trying to cause pain for Hyperliquid, and obviously their competitors in some sense.
Yeah, and actually, I would just tweak that to say, like, I saw at least for Binance that users were requesting it, and then I saw Hayi, the co-founder, she said like something like, oh, we're looking into this, and then it did get listed. So whether or not it was,
I guess that's
technically,
true. I mean, I guess it was a very active coin at the time when it was going on, right? So I guess you could make the argument that regular Binance users probably would want to, trade it as well. That's
yeah. And I just mean, it may not necessarily have been Binance that was pushing the price of the coin up, but it could have just been the users. But the fact that, yes, they opened up kind of like new liquidity or new buyers for this enabled that, even if it was other people that were actually.
It could just be the anticipation, right? Even before a single Binance user buys it, if everybody in the market knows, the Binance is committed to listing it, right? Like even just regular Solana users are more likely to come in and kind of buy it.
Yeah. So there were some points here about how it was that Hyperliquid resolved this situation, which was they delisted Jelly, and then, as you mentioned, they forced it to get liquidated at the price before what I think, like in traditional law, would probably be called some form of manipulation. I understand words like that get into like intention and whatever, so it's complicated, but I think like most people, just without looking into all the details and knowing too many of the facts, would say this resembles that. So, how did those decisions get made? Like, who voted it in? Is your perception that it was done in a centralized way or a decentralized way? And how do you even override an oracle? Because the whole conception is that it's bringing in information from outside. And so the word oracle is because they're supposed to be the ultimate authority on something like that. So how did all this happen?
Right. So the thing to understand about Hyperliquid is that it is, it is a DEX, but it itself is also the chain as well as the oracle. So it doesn't use an external oracle. It uses an internal oracle, which is generated by the validators on the chain. So there's a rule set where it, looks at the price of different sources, Binance, OK, Coinbase, wherever coin's listed, has some formula for how it generates the oracle price, right? At least it's like what's documented, right? But ultimately, right, that's just software. So, and that's just part of the rules of the blockchain itself. And because it is both the DEX and the blockchain, it can obviously fork or upgrade the blockchain in the network. If the validators all agree to it, it can fork or upgrade the blockchain in whatever way it wants. So in some sense, it's actually, analogous to the DAO hack way at the beginning of Ethereum, where, something really bad happened and you said, okay, this is kind of bad. This is a major threat to the network. So, right, we have this dilemma. Are we going to follow the exact rules, or are we going to, upgrade the chain in a way to kind of prevent this bad actor? And so that's what it did. So the validators, as far as I understand, the validators in the network all convened virtually and discussed it and kind of all agreed, or at least the majority of them agreed, that for this one particular case, they're going to change the rules instead of change the rules, and therefore change the oracle price, and therefore use this alternative price, which is possible because Hyperliquid is its own blockchain. If it was running, for example, say on Solana and used an external oracle like Pyth, that type of thing wouldn't have been possible, at least like easily.
Yeah. And actually, I would, for the same exact reason, kind of say that the analogy between the DAO and Ethereum is imperfect in the sense that the DAO was, a separate entity, was an
Yeah,
application
that's
on
true.
top
Yes,
of
that's actually
Ethereum.
true.
Yeah. But you're right. In this case, because the quote unquote app and the chain were the same. That's also how they were able to do that. So, when you tweeted about how they had decided to override the Oracle, I saw that Zach XBT replied, quote, kind of annoying if they draw the line here, but not when DPRK, meaning North Korea, had reasonably sized positions open with funds from the Radiant hack. And I also saw, this was like in a different thread, but he said, when it's the Radiant hack with DPRK funds, which had thousands of victims, they claim they can't do anything, even though they were notified in a timely manner. When it's a low cap PvP meme coin, the couple of validators and huge percentage of stake is controlled by Hyperliquid, and they rush to close positions at an arbitrary price. So I think he's basically saying this is a little bit hypocritical, if I'm going to paraphrase. So what's your take on his comments there? And by the way, one other tweet that I saw that kind of made me chuckle was crypto security researcher and North Korea expert Taylor Monahan replied, "Losses for thee, but not for me."
Yeah, no, I mean it's these are really kind of tough questions, especially the chain itself, and especially in the sense where a chain and an app are one and the same. There's an argument, right? There's conflict of interest here, and this is why like Ethereum kind of bends over backwards to be credibly neutral. Usually, again, like the DAO hack might be an exception, but in some sense, right? Like any chain could, fork out any situation, like right, if enough of the stake votes on something. So this is, you could lodge the same criticism. Why doesn't Ethereum validators and stake get together to fork out North Korea as well, right? Because there's obviously funds on Ethereum that are attributable to North Korea or other hackers. So right, so I think there's an argument to be made that right, like Hyperliquid is a blockchain and they wanted to be credibly neutral, and the same way you wouldn't expect Ethereum to fork out to freeze North Korea's funds, you wouldn't expect Hyperliquid as a blockchain to do the same. Or right, and how far do you go? Right? Is it North Korea? Is it anytime either tax evader or somebody else is on it? Anytime, right? Like there's a government subpoena, do you have to comply with it? So there's kind of this slippery slope argument. That being said, right, they did convene to change the rules, or go different than kind of what the rules they committed to are. So I think right, that's where Zach's argument is coming in, is that if it's you're looking at your own losses, there definitely is a potential kind of conflict of interest there, motivated reasoning from their side. So if you can arbitrarily change the rules for one thing, why can't you arbitrarily change the rules for the other thing? It's a tough question. There's good arguments on either side, to be honest.
Yeah. I did see like a whole range of tweets criticizing them, but then a bunch of tweets defending them, other, people who work on protocol saying I would have done the same thing, et cetera, et cetera. So I don't know if there's necessarily one right way to have handled it, but I do think like if you are leaning more on the neutral side, it could have been like, take the loss, learn the lesson, change how it's set up moving forward so that a bad actor like that couldn't necessarily get away with the same thing. Whereas, I do think now because of the contrast with the North Korea situation, they did open up this, avenue of criticism that they had done something in their self-interest, but then when their users lost money, they didn't do the same to step in. But I saw that you had, kind of another solution for something going forward. You tweeted, I think one thing the Hyperliquid attack today revealed is that the liquidity vault should not be the backstop of last resort. And it went on to, more detailed thoughts. So can you elaborate on your commentary there?
Yeah. So one of the central issues here is that early on, HLP was like very important to bootstrap the network, and then from the liquidity side, they've actually moved kind of away from it to the point where only a small percent of liquidity nowadays comes from the HLP vault. But in terms of liquidation, they're still very dependent on the HLP vault. And again, I'm just going off of like documentation and what I've seen. It's hard to say exactly what it is because it's closed source. But what happens is that, the liquidity vault, as far as I can tell in Hyperliquid, always, if a position can't be liquidated in the normal market, the liquidity vault's always the buyer of last resort. So it takes over the position if something can. And that happens regardless of how large the position is. And that's exactly what the exploiter took advantage in this case. So the issue is, right, like if you have a trading strategy, you really never want because the vaults are a trading strategy. They're trying to make money, same as anything else. And normally liquidations are very profitable because you're getting positions at very dislocated prices. Like these are normally very profitable things. So 99.9% of the time, just saying, give me all the liquidations, you'll make a lot of money. Very small percent of the time, especially if you're being attacked, you don't want those. So what I suggested, and we've thought a lot about, because we're also as a DEX looking in the perp space, as I assume many other DEXs are at this point. But what we've thought a lot about is how can you have something where the vault, if the vault doesn't want to take a position, which I think is reasonable, there should be certain times on very low liquidity coins, the vault doesn't want to take a position. You should have something else, right? Like you should have a way to gracefully de-escalate. And probably what should happen is that during liquidation itself, if you could auto delever then instead of auto delevered, really manually delevered much later on after the situation had kind of gone out of control. If you just had a system where you auto delevered when the vault is past its risk controls at the price that it happens, it's kind of a lot cleaner solution, because the same thing happens, right? You're forcing positions to be closed. It's at a certain price, but you don't have time for the price to be manipulated. It's happening right away. The vault never takes on the position, so it never has losses. And I think kind of the really important thing here is, like, number one, you don't want the vault to take on limited risk. And number two, you want very clear rules about when the vault is past its pain point in either case, right? Because the vault's eventually going to hit a pain point, and so it can't take on infinite position. When the vault's past its pain point, very clear rules about these are how things de-escalate and delever, and you want to do it as early as possible. So you don't have time for things to be manipulated, or once you have positions or other ways to take money out of it. So just the sooner the better. So I think in this case, and kind of tying back to what we said, the most important thing is just the rules are, if you can make the rules clean ahead of time, there's going to be much less controversy, because you're not going to be fighting about things afterwards. You just say, these are the rules, everyone signed up for them, and kind of we applied them in a neutral way.
And then I have to ask you about, what Binance and OKX did there. As we discussed, some people thought it was shady. Other people noted, including Zach XPT, that the original whale who started these trades had actually funded their position from a withdrawal from Binance. And there was some speculation about, therefore, what it meant about their identity. I don't know if you have an opinion on that, or just, what Binance.
I mean, it's hard to, just because something comes from obviously a lot of people use Binance who aren't Binance users. So, it'd be very difficult to speculate. But I mean, at the very least, if somebody directly took money, we know Binance users usually, right, we know their identity. So it's at least a sign that whoever did this was reasonably confident that they wouldn't be prosecuted, I guess, wherever they were.
When you say we know their identity, you mean because, like, law enforcement?
Well, if you sign up for Binance, you have an account of Binance, you usually have to KYC. So if you go and commit a crime with address tied to Binance, usually, right, a prosecutor could find out who you are.
Yeah, not like any public person, but yeah.
No, I'm sorry, exactly. I didn't mean that. I meant we as in the collective sense. Law enforcement could identify them if it had the situation escalated past a certain point. So these types of, whether they're hacks or they're highly profitable trading strategies, I think there's always debate about whether they're legal or illegal, and sometimes people do them and don't think they're going to get in legal hot water, and then they do. But it is interesting that whoever did this, I guess, was relatively confident either where they live or their jurisdiction, that they were kind of in the clear.
Okay, yeah, and I guess as we discussed about Binance and OKX's decision to list Jelly, that there's multiple ways you could view that. One is maybe they're just responding to user demand. However, I did see Kevin Zhou of Galois Capital. He had a kind of long tweet thread about implications for all the different entities or similar types of entities that were involved here. He said, quote, "Every decision sets precedent for the future. Binance and OKX listing perps in Hyperliquid's face does help their short-term incumbency status, but it also sends the message to other centralized exchanges and DEX competitors of what to expect if they take on bad liquidations. And then he went on to say that, most likely exchanges that are challenging these incumbents would first improve their risk management, which he said would create stronger competition for the incumbents. And then he said this would also actually create a chilling effect on cross-exchange coordination attempts, such as any attempts to create clearinghouses. He also said that the way the validators acted here in Hyperliquid could create what he called overinvestment into HLP. And he said, if HLP investors know that they capture full upside and will get bailed out on big downsides, more capital will come into the vault and drive down yields. There were other things, but just generally, what was your take on his assessment here?
As usual, I think I agree pretty much with whatever Kevin said here. Usually he's spot on. But yeah, I think that's right. Like the big thing being right, like even had this attack succeeded, right, it would be a $60 million loss, which wouldn't have been existential for Hyperliquid, right? It's obviously a $10 billion plus protocol, generates a ton of revenue, right? The same way like Bybit's recent hack was not existential for Bybit. It may be painful, but they'd be able to probably cover it or kind of compensate people in various ways. So in some sense, right, it's like these things are interesting. DEXs have a lot more of a challenge, especially in perps or derivatives, because they can't easily assign who's who. People can easily spin up wallets. So DEXs have a lot more like levers to push to kind of limit this type of risk and manipulation that DEXs don't have. So to the extent this is kind of happening in real time and like Hyperliquid and others are learning, I think the point is, right, like it whatever kills you only makes you stronger.
Okay. And last question. So obviously, I'm sure from this point forward, Hyperliquid is probably going to change up a few things. If you were in their shoes, what would you recommend they do?
Yeah, I'd say the biggest thing was two things. Number one is kind of like what we talked about before, having an alternative on the liquidation side. The second is definitely, I think they're looking in retrospect, this coin probably should not have been continued to be listed. It might have had a lot of activity the first week it was out, but kind of all the drama and issues it caused was not worth whatever the very, very tiny amount of activity people wanted to trade on. So I think the big thing is kind of these longer tail assets, even if they're the hot coin of the day, I think they're probably thinking more coins you have, the more risk you have, and the more liquid coins, especially the more risk you have. So I'm almost positive internally they're taking a long, hard look at kind of cleaning out a lot of illiquid markets.
Yeah. Okay, Doug. Well, this has been a great conversation. Thank you so much for coming on Unchained.
Thanks for having me.
Don't forget, next up is the weekly news recap, today presented by Wondercraft AI. Stick around for This Week in Crypto after this short break. Mantle is revolutionizing its on-chain financial hub. Powered by a $4 billion treasury and proven products like Mantle Network and METH protocol, Mantle is launching 3 innovation pillars: Enhanced Index Fund for optimized crypto exposure, Mantle Banking for blockchain-powered banking, and Mantle X for AI-driven innovation. Experience the future of finance with Mantle and follow Mantle on X to stay tuned.
Welcome to this week's Crypto Roundup. In today's recap, we break down why everyone from World Liberty Financial to $5 trillion asset manager Fidelity is getting into the stablecoin game. We also explore why GameStop shares tanked after plans to raise more than $1.3 billion in debt to buy Bitcoin. Plus, crypto companies celebrate the removal of a key rationale by banking regulators, which they believe had put a target on their backs. And we discuss why Kraken is planning to raise up to $1 billion before it goes public. Finally, the Ripple versus SEC saga is over, with the regulator only walking away with $50 million after asking for as much as $2 billion. Thanks for tuning in to the weekly news recap. Let's begin. Everybody gets a stablecoin. With stablecoin usage surging and growing momentum for a piece of legislation in Congress that will set the rules of the road for the digital dollar industry, more and more companies are looking to get into the game. On Tuesday, World Liberty Financial, a crypto project founded by family members of U.S. President Donald Trump, announced the launch of its own stablecoin, dubbed USD1, which will be backed by short-term U.S. treasuries, U.S. dollar deposits, and other cash equivalents, the company said. The token will be issued on the Ethereum network and Binance Smart Chain, a blockchain created by Binance, the crypto exchange that has sought to forge closer ties to the president's family. The Trump family launched World Liberty Financial in October, billing the entity as a decentralized finance, or DeFi, project that would help match crypto investors eager to borrow and lend from and trade with one another. Critics have said World Liberty Financial's stablecoin launch poses a major conflict of interest for President Trump. "We haven't had a president in recent memory ever sign legislation that could directly affect his financial interest," said Kedrick Payne, Senior Director of Ethics at the Campaign Legal Center, an ethics watchdog group, to the Wall Street Journal. "It is a clear violation of the ethics norm." Not to be outdone, $5 trillion asset manager Fidelity is also in the advanced stages of testing its own stablecoin, according to the Financial Times. Additionally, the state of Wyoming is making steps towards launching a stablecoin later this year, which could be the first fiat-backed and fully reserved token issued by a public entity in the U.S., state officials said at the D.C. Blockchain Summit on Wednesday. The Wyoming stable token, WYST, is currently being tested on Avalanche, Solana, Ethereum, Arbitrum, Optimism, Polygon, and Coinbase's base testnets, according to a press release. And finally, Custodia Bank, working with Vantage Bank, completed America's first ever tokenization of a bank's U.S. dollar demand deposits on a permissionless blockchain by issuing, transferring, and redeeming stablecoins for a bank customer on top of Ethereum, according to a company press release. Crypto exchange Kraken explores up to $1 billion debt package. Crypto exchange Kraken is exploring raising as much as $1 billion in debt ahead of a potential initial public offering, according to a Bloomberg report, citing people with knowledge of the matter. The company is working with investment banks Goldman Sachs and JP Morgan Chase on the effort, which is still in preliminary stages, according to the sources. The two banks have also begun conversations with additional banks and direct lenders, the report said. Any debt raised is set to help fuel the company's growth and isn't for operational needs, according to one of the sources cited in the report. As little as $200 million could be raised, they said. Kraken provided details on its annual financial performance for the first time back in January as one of several companies in the crypto industry that is readying for a potential IPO and could go public over the next 12 to 18 months. The company reported an adjusted EBITDA of $380 million based on $1.5 billion in revenue, which more than doubled its 23 performance of $671 million. Trump Media announces intention to partner with Crypto.com to launch ETFs. Trump Media and Technology Group, TMTG, has announced a non-binding agreement with Crypto.com to launch exchange-traded funds, ETFs, through its fintech brand Truth DeFi. The partnership will utilize Crypto.com's broker-dealer, Forest Capital US, to create ETFs focused on digital assets and Made in America securities. The planned ETFs will include a unique basket of cryptocurrencies featuring Bitcoin, BTC, Crypto.com's native token Kronos, CRO, and other crypto assets, according to a press release. The funds are expected to launch in 2025 across the US, Europe, and Asia. Crypto.com will provide back-end technology, custody services, and cryptocurrency supply. TMTG plans to invest up to $250 million of its cash reserves in these ETFs and accompanying separately managed accounts, SMAs, with investment firm Charles Schwab serving as custodian. The products will be available to Crypto.com's reported 140 million users, subject to definitive agreement and regulatory approval. The partnership with Crypto.com comes as the community behind its Kronos blockchain continues to reel following a controversial vote, where Crypto.com went against its community's wishes to push through a proposal to reissue 70 billion tokens that were supposedly taken out of circulation in 2021. Part of the rationale for reminting the tokens, an unprecedented step for the crypto community, was to create a CRO-backed spot ETH. It is a spit in all CRO holders' faces, wrote one CRO validator who voted against the reminting proposal to Unchained on Telegram. SEC only gets $50 million from Ripple. Ripple Labs has agreed to pay a $50 million fine to end the U.S. Securities and Exchange Commission's years-long investigation into the Ripple-linked firm, the company's chief legal officer, Stuart Alderodi, said on Tuesday. The SEC will keep $50 of the $125 fine. Alderodi wrote in a post on X, formerly known as Twitter, referring to the penalty Ripple Labs was ordered to pay by a New York court in August over unregistered XRP sales to institutional investors. Alderodi said that Ripple has meanwhile agreed to drop its cross-appeal of the U.S. District Judge Annalisa Torres's decision, which found that XRP is not necessarily a security on its face, especially within the context of programmatic sales to unknown buyers. The SEC, under the leadership of former chair Gary Gensler, sought a $2 billion penalty against Ripple Labs for what it claimed were unregistered securities transactions. The SEC first brought its lawsuit against Ripple Labs during U.S. President Donald Trump's first administration. GameStop tanks on plans to buy Bitcoin. Video game company turned meme stock. GameStop's shares fell sharply on Thursday after the retailer announced plans for a private offering of $1.3 billion in convertible senior notes to use toward general corporate purposes, which could include investing in Bitcoin. Investors reacted negatively to the announcement, while analysts questioned the timing of the decision. We find it hard to understand why any investor would pay more than 2x cash value for the potential for GameStop to convert that cash into Bitcoin, particularly since the same investors can invest in Bitcoin or a Bitcoin ETF themselves, noted Wedbush Securities analyst Michael Pachter to Seeking Alpha. Intercontinental Exchange partners with Circle to explore new product offering. Intercontinental Exchange, ICE, the parent company of the New York Stock Exchange, is exploring using Circle's USDC stablecoin and USYC tokenized money market fund to develop new products and services. We believe Circle's regulated stablecoins and tokenized digital currencies can play a larger role in capital markets as digital currencies become more trusted by market participants as an acceptable equivalent to the US dollar, said Lynn Martin, president of the New York Stock Exchange, in a statement. We are excited to explore the potential use cases for USDC and USYC across ICE's markets. This news comes as the total stablecoin market, led by Tether's USDT with a $144 billion market capitalization, continues to set all-time highs. The tokenized treasury market continues to grow as well, surpassing $5 billion for the first time as the assets are increasingly used for leverage in margin trades. Major bank regulator removes key rationale for blacklisting crypto industry. The Federal Deposit Insurance Corporation, FDIC, appears to be following in the OCC's footsteps by also moving to extinguish the use of reputational risk as a way to supervise banks. The FDIC is actively working on a new direction on digital assets policy, said Travis Hill, who was appointed acting chair of the FDIC in January by President Donald Trump, in a letter sent to Repreno Dan Moser, RP, on Monday. Hill had previously urged the agency to take a more open approach to crypto. In his letter, he said banking regulators should not use reputational risks as a way for supervisory criticisms. While a bank's reputation is critically important, most activities that could threaten a bank's reputation do so through traditional risk channels, e.g., credit risk, market risk, etc., that supervisors already focus on, Hill said in the letter obtained by The Block. And that's all. Thanks so much for joining us today. If you enjoyed this recap, go to unchainedcrypto.com newsletter, that is unchainedcrypto.com newsletter, and sign up for our free newsletter so that you can stay up to date with the latest in crypto. Unchained is produced by Laura Shin, with help from Matt Pilchard, Juan Aranovich, Megan Gavis, Pam Majumdar, and Margaret Correa. The weekly recap was written by Stephen Ehrlich and edited by Carrie McMahon. Thanks for listening.